Hey, what's up, everybody? Thank you for joining us here once again. And today, Josh and I are talking about some credit mistakes that we've seen our clients make. And we want to maybe share a couple of tips and tricks so that you don't make the same mistakes that some of our clients have made, and possibly even eliminate some of your future heartbreak. So, Josh, thanks for joining me. What's the first thing we want to talk about here?
Well, there's a couple of really big mistakes that can absolutely impact your ability to buy your first home here in 2025, or refinance or anything else that you're looking to do with respect to mortgage financing. And so the first one I'm going to talk about is how you manage your revolving credit. That's your credit cards or your unsecured lines of credit. Those are really important, and the way you manage those has a massive impact on your credit score and your ability to borrow. The big one that I'm going to talk about is your balance to limit ratio. So let's imagine you have a credit card with a $4,000 limit. If you can keep the balance on that card to under half of your limit, so under $2,000, you're going to have a much higher credit score than you would if you get above 75% or even approaching that limit, and heaven forbid you go over the limit. Jay, as you get really close to that limit, it's going to drop your credit score like 50 or more points if you go even $1 above the limit. And that might just be when the statement comes, they apply interest, pushing you over that limit. It's going to have a massive, maybe 100 or more point impact on your credit score. And sometimes that could be the difference between you qualifying to purchase a home and you not qualifying at all.
Something that I've learned over time, and I've been advised to do, is that with any of my revolving credit is understanding, the statement date. I have to make the payment anyway. So if you make it earlier and drop that number down, when these creditors are looking at the statement amount, if it's lower, that's better. It'll keep us underneath that ratio. So what I've gotten in the habit of doing is just making payments even bi-monthly. And instead of one big payment, I have two little payments, and it seemed to have worked well for me. So if you like this content, you find it helpful, please like, subscribe, even leave us a comment on our channel. It helps us grow, and it'll help us to continue to make these videos. Josh, what's the next big mistake that we're seeing people make?
Yeah, this next one might even be a bigger mistake than the credit card issue. This one has more to do with how much you're going to qualify to borrow when you're purchasing a home, and it's taking on large debt payments. Most often we see that in the form of a vehicle or a truck loan. Sometimes it's in the form of having co-signed for somebody else's vehicle or truck loan, which is almost worse. So what we see is when we're qualifying somebody to get a mortgage, it comes down to a couple of ratios. One is your gross debt service ratio. The other is your total debt service ratio. And we're going to talk about that second one, also known as the TDS ratio. The total debt service ratio can be up to 44% in most cases of your gross income. So let's say, for example, you make $100,000 in your household, and that could be two of your incomes, maybe some Canada Child benefit. That $100,000 works out to $8,300 a month of income. And of that, up to 44% can go toward your monthly payments. And that would be when we're buying a home or looking at a mortgage, the mortgage payment, the property taxes, some heating, as well as your car payments and the minimum payments on any of your credit cards or lines of credit, or even your student loan payments. So what we see is there's an allowance for about 5% of your monthly income to go toward other debt payments before it impacts what you can do on the mortgage. But if you exceed that, it actually has a massive impact on how much you can borrow. So with that same $100,000 income, you can have up to about a $420 monthly payment on a car before it makes any impact. And so if your payment is less than that, typical Edmonton property taxes, and assuming no condo fees, with interest rates today, you could be looking at purchasing a home at 5% down for about $470,000. Not a bad number based on a $100,000 household income. But you know what, Jay, if you increase the payments even just $100, it's going to reduce how much you can spend on that home by about $18,000 down to $452,000. And that's just by having an extra $100 a month in payments. And that's not very much, but has an oversized impact on how much you can qualify to borrow looking to apply for a mortgage.
That's incredible. So what I've suggested to so many of my buyers is like, give Josh a call, go see your mortgage broker or the bank and figure out a strategy. What are we going to do here to make sure that we make the right decision now, or maybe even make some change in our current sort of economic climate that we're facing right now? And that'll help us understand what we can buy. And so I would encourage you very much, reach out to Josh and his team and book that appointment, have that call, and let's see what we can do to help you become a homeowner here in 2025.
Yeah, so let's talk about that, because if you go and get that truck with that $800 or $1,000 a month payment, that you're not going to buy a home. And I don't know about you, but I would rather sleep in a bed in my home than have to sleep in my truck, because that's all that I can afford to pay for.
Totally agree. Josh, thanks for all your help today. I look forward to making our next video here soon.
Thank you.